Good morning, everybody. Welcome to what I hope is going to be an exciting conversation today of state of the economy. My name is Matt. My name is Matt Hudson. This is my partner, Mike Aiden. Hey guys, Mike's going to do a quick introduction here in just a second of our guest. What I want to encourage everybody as we're having our conversation today, put your questions in the chat as you ask those questions. We have somebody who's going to capture those and then hand those to us, and then we're going to do some rapid fire with Elliot at some point through our conversation today.
You bet. Well, we are thrilled to have Elliot Eisenberg here with us. Elliot, thank you so much for joining us here again. You spoke to, or with us, I think that was August when you were here as well, and just thrilled to have you back. For those of you that don't know, Elliot is an internationally acclaimed economist, public speaker. He has accolades longer than a list of paper that we can have in this room. So he's known as the Bowtie economist, which you can see fits as well, and just an extremely knowledgeable individual, and really takes the minutia of economy and economics down to a very understandable level. So Elliot, thank you for being here with us.
Thank you for that nice, warm introduction. Thank you very much.
Absolutely.
Elliot, our conversation today, it's a pretty interesting time. We've got a new administration coming in that in 5 days that is probably as polar opposite as maybe we've experienced in the history of the country. Potentially, we could debate that. So there's going to be some policy changes likely to be made. And as we talked about back in August, you were a little concerned about both candidates and whether or not the changes that they were going to make were actually going to stabilize the economy. So we want to have kind of this big picture, macroeconomic, maybe even geopolitical conversation as those ingredients influence what you're seeing in the direction of the economy. Talk a little bit about policy, and then whether it's about Federal Reserve or tax policies or what have you. And then ultimately we want to as much as we can distill it down to what's happening with the front range of real estate in Colorado based on those cascading set of events. So thanks for joining us today. We're excited for the conversation.
My pleasure. So when I visited you in August, I was nervous about both candidates. I wasn't particularly pleased with what either of them was really proposing. Now we've got one of them, and I'm guardedly optimistic, I would say. Trump's got a number of ideas, some of them involving energy, which I think they can be mildly positive. Just because he suggests that we drill doesn't mean drillers are going to drill in Texas or Oklahoma or wherever it is, right? But he makes the environment better. He could maybe allow more permits for liquid natural gas to travel off to Europe or Asia or wherever it is. That can be helpful. Deregulation, certainly helpful. Tax extensions of tax cuts. Well, something will come through. I'm not sure how much. It depends on his majority in the House is very, very small compared to what it was 8-9 years ago. He had 47 or 48 seats. Now he has 4 or 5 or 3, depending on Elsie Stefanik. She has to resign to take the job in the UN, and Mike Walls and so on. Small majorities, worse fiscal situation, budget deficits bigger, debt to GDP ratios higher. So it'll be hard. There'll be some conservative Republicans who aren't going to want to play along. So we may not get those tax cuts, or as much of those tax cuts as we hope. And then, of course, there are the big kahunas, tariffs and immigration reform, or sending people back to their country of origin. And Trump's a very smart guy. He knows that part of the reason he won the election was inflation drove us all to distraction. I don't think he really wants to impose regulations or rules or legislation that increases inflation all that much. So he's going to do it delicately, more slowly, less intensively, whatever it is. But he's not going to make the same mistake and generate inflation. As far as the Fed is concerned, the Fed's in a waiting game right now. There's a couple of things that have happened that have caused the Fed to put the brakes on. When the Fed cut rates dramatically by 0.5 point about 3.5 months ago now, they saw rapid deterioration in the labor market. They saw unemployment going up, and they were very nervous. Wage growth was starting to weaken, and they were nervous. And they cut rates 0.5 point, then 1/4 point, and a couple of weeks ago, they cut again 1/4 point. The last cut was kind of like a jump ball. And they're done now because unemployment has stopped going up. It went from 3.4, 3.5, it went to 4.3, and now it's come down to 4.1. And it's been between 4.1 and 4.2 now for 3 or 4 months. So the Fed sees unemployment not going up, they don't have to raise rates. Moreover, they see inflation has stopped coming down and it's too high. Their preferred measure, PCE, inflation core, whatever, it's about 2.5, 2.6. It's not 2. So if inflation is not coming down, unemployment is not going up, they don't have to raise rates, lower rates. So they're not going to lower rates. And they told us when they cut rates last time, they're not going to lower, they're going to cut rates less. And that jacked long-term rates up. So we think short-term rates by a full percentage point in the last 3.5 months, but then long-term rates, which leads to the 30-year mortgage, have gone almost up a full percentage point. It hasn't helped us in the slightest, essentially. So it's people thought, well, rates are going to come down, they'll cut more, things will get better, cheaper. No, went the other way around. Very unusual. And the Fed's now waiting. The Fed doesn't want to cut rates more because they're fearful if they cut rates, they may have to raise rates. And if they have to raise rates early in Trump's administration, they're going to get the wrath of Trump. I think Trump will start beating on Powell like he did back in 18, 19, and 20. And Powell thinks, look, my term is going to end in a year and 5 months. Let the next guy deal with this problem, or woman, as the case may be. Let he or she deal with the problem. I'd prefer not to. So, in a risk management perspective, his policies have an inflationary bias. Unemployment and inflation aren't giving them permission to lower rates further. Let's let it ride and see what happens. And that's a reasonable approach. But that means interest rates for homes are higher than we'd like them to be, and higher than they may well end up being later on, which is pretty.
Yeah, question for you on that. I mean, Elliot, I just wrote down 18 different bullet points and everything that you just shared. A whole bunch of questions around, kind of how unemployment is actually measured relative to how it used to be measured, how inflation is measured, how it used to be measured. There's a little bit of inside baseball, I would say, for today. We can have that as a separate discussion another time. But I think what would be meaningful with respect to the housing market in particular, because the primary driver of velocity in the marketplace or volume of activity in the marketplace and the speed at which buyers and sellers are making decisions ultimately comes down to what is the cost of capital. And then ultimately, how does that translate to what is my payment on a home? And so can you explain to the audience in some lay terms, what are the primary levers that are driving mortgage interest rates, and why is it that we are seeing the 10-year Treasury jump as much as we have in the last 3.5 months?
10-year Treasury has gone up because the long-term interest rate, the terminal rate that the Fed wants to get the economy down to, the neutral rate, the rate that's not expansionary or contractionary, the Fed thinks it's kind of gone up over the last couple of years because of fundamental changes in the economy that's resulted from COVID. So they're saying, well, we're going to cut less. We think at the end of the day, we're only going to cut rates by half a point from where they are, where we used to think it might be down by 100 basis points or a full percentage point. That taking away those half a percentage point of rate cuts has caused long-term rates to go up. Now, there are more drivers of long-term rates than just that. There's other drivers they include, I think, two major things. One, investors who buy these mortgage rates now, who are buying mortgages from Fannie and Freddie at these high rates, 7%, right? The investors are telling themselves, this isn't going to last very long because these borrowers are going to refi in 6 months, 12 months, 18 months, whatever. So I'm gonna be stuck with a much lower rate in the future. So I better get an even extra bonus points now for taking the mortgage. And the second thing
you're talking about that excess you're talking about that excess margin that
correct.
is built in by. Yeah.
So historically, pre-COVID, the gap between the 10-year mortgage and the 10-year Treasury and the 30-year mortgage was 1.7 percentage points, ballpark. Now it's more like 2.5 or whatever it is, in part because of that, and in part also because there are fewer originators out there making loans. So if you want to get a loan, you want to buy some loans, there aren't that many places to go and get a bag of loans from, if you will. So they can afford to be a little, they can keep a little extra points for themselves too. So there are a bunch of factors in the Fed and the uncertainty that's resulted from the Fed. So the Fed, the rates are high now, but they may come back down again. We've been through this before where the Fed says, "Oh, I don't feel very good." And then the market front run the Fed. So the Fed says we're going to cut from 4 cuts, we're going to do 2 cuts. Markets think zero, rates go crazy. 6 months ago, uh, September, October of last year, the Fed said, "Oh, we're going to cut 4 times." Markets thought 6 or 7 times, and then rates go way down. So we'll see this game before it's through. This isn't the end of this process.
So if you had to guess, and we're getting a little bit of delay with you, so we'll Mike and I will give our economic interpretation if we end up getting cut off with you, which will be short. Yeah. But if you had to prognosticate what's going to happen over the next 12 months with mortgage interest rates, what's your best guess?
That would be, they fall 25 basis points, 50 basis points if we're lucky, so 0.5%. If you get that, I'd be a happy camper. Because again, President Trump's got some inflationary bias in some of his policies here. So we're going to be working at cross purposes to some extent. So I wouldn't expect huge declines here.
Yeah.
Is my interpretation of this correct? That the more enthusiasm there is essentially for the strength of the equities markets, the more the government actually has to offer to an investor to actually buy a 10-year bond, meaning the yield on the 10-year bond goes up. So as the Fed actually cuts rates, there isn't a correlate impact to mortgage interest rates or the 10-year bond. What it says is there's because of a combination of deregulation, less cost to business as a result of, in theory, the cost of energy coming down, and more enthusiasm around businesses growing, that people are going to put money into the equities markets as opposed to the bond market. That's what drives up the yield, and that's what drives up mortgage interest rates. And then you add the margin from mortgage-backed securities on top of that. Is that an accurate statement?
You got it. Right. So the Fed lowers rates. People think, oh, that's going to be great for the stock market. People take money out of the bond market. They can make more money in stocks and bonds. And they put it in the stock market, jacking the stock market up, and that drives rates up. Right. You have to be more competitive with a better stock market. Absolutely. That's also helping cause the situation. And remember, we will take collectively as an economy, as realtors, whatever, business women, whatever, a better economy and higher rates. That's a better trade than a crappy economy and lousy rates, generally speaking.
Yeah.
So
makes perfect
depends
sense.
why rates are going. If it's inflationary, it's bad. If it's good GDP growth, it's okay.
Yeah. Okay. So if you had one or two particular characteristics of either policy or economy that you would recommend people kind of pay attention to if they don't want to absorb those 18 different points that you're looking at, in addition to all the historical that you're analyzing, what are the one or two or maybe three primary characteristics that you would suggest somebody pays attention to or begins educating themselves on?
The most important, look, inflation, because the Fed's following inflation, so you have to follow it because they're following it. I think that's yesterday's game, but what we can argue. The one I'm looking at most importantly going forward is unemployment. If it starts to rise, we're going to be cooked because the labor market weakens and we're all in trouble. The labor market is weakening, but it's not weak. It was very, very strong. It's now just strong. But the Fed, as I mentioned earlier, began to cut very intensively back in September because they were fearful it was going to continue to get worse. And it suddenly stopped getting worse and has actually improved a little bit since then. So the Fed's off the hook now. But if they see deterioration again, unemployment starting to go up, they're going to start cutting rates. So I would look at inflation as the number 2 variable to look at, and unemployment is number 1, or vice versa. But those are the two you really want to key in on, the macroeconomic level, not the housing level, but the macro level.
Okay. Yeah, I think we'll pivot into housing here in just a second. One more question. You made a pretty interesting comment. It relates to housing, but you made a pretty interesting comment to me and Mike when we were talking on Monday, and it was a characteristic of the economy and how it impacts the housing market that I hadn't considered before, and that is immigration. Can you explain just a little bit about how the policy around immigration may actually impact, from your perspective, the housing market?
It's been impacted a couple different ways. First, we know that home builders use a lot of imported labor on job sites, and they use I'm sure I'm not disparaging home builders here. Don't get me wrong, right? But workers are available, and you can get them on the job site, and they'll work, and they're good workers, and they're honest and hardworking. They may not have the best papers, but if we don't bring them in, it gets hard to build houses. So we know that construction, agriculture, leisure, and hospitality are sectors that are particularly prone to using migrant labor or new labor or whatever it is. So that's one issue. The other is if we ship a number of these off back to countries of origin where they come from, whether it's Mexico or wherever it is, whatever, Ukraine perhaps, and whatever, there'll be more rental property available to them. So this has all kinds of interesting ramifications that can result. We don't know how many people are going to send back and how this and how that, but I would keep my eyes peeled on this. This is a big deal. And some of these, and you're going to see this impacting different communities in different ways. Communities that are very agriculturally based, so parts of Colorado, not so much the Front Range, obviously, where there's less farming and ag, but Eastern Colorado and Western Colorado, different types of ag. You may see more significant impacts from this on the agricultural side, in vacant apartments or whatever it is. So yeah, there's a lot going on there.
Either I'm deaf or you cut out a little bit. And I just wanted to have you maybe explain a little bit more. When we were talking on Monday, you said that and it's really not maybe immigration, it's actually deportation. We're talking deportation policy. And
yes.
it was pretty shocking realization when you shared this on Monday that the idea that if we deport a bunch of people, that may actually have some cascading effect on the value of rental properties.
Absolutely. It will come down. There's no question. Again, if it depends how many people are deported. If it's 100,000 or a million, yeah, whatever. If it's 2 or 3 million, it can be a lot. If it's 4 or 5, it can be very, very large. So you could see declines in rental property in parts of the country or parts of the state where you've got a lot of leisure, hospitality, agricultural workers, and so on. Yeah, it's a big deal. It's a sub rosa housing policy, if you will. It's not the plan, but that's the outcome.
Yeah. Okay. Yeah. No, that's fantastic to hear, though. I mean, it allows us to provide more insightful advice to investor clients. Sounds like maybe I would have some impact in the up and down the Front Range, maybe more so in kind of southern Colorado Springs or northern Denver, but in the Denver area proper, we don't have too much construction or agricultural happening in the heart of the area. So probably not as big of an impact on rental values.
But as you say, in the periphery of the metro area, that's where you're more likely to see the impacts.
Yeah. Maybe more areas like a Sacramento, where you're kind of tier 2 cities. Yeah. Okay.
Absolutely. Yes.
As we pivot, let's dive in a little bit more to the Denver and Front Range economy, Elliot, as well. The majority of the folks that are with us today live here in Colorado. I know when you were with us in August, I was interested in hearing you talked about the Denver economy being poised pretty strongly, honestly, just because of our diversity of industry, population growth, et cetera, et cetera. So let's dive into that just a little bit more. What differentiates the Denver, Colorado Front Range economy different from some of the other cities and stuff that you research and you
part of it is diversity. You think back to the bad old days of the mid 80s. When oil prices collapsed and Denver became a ghost town, and you had tumbleweeds going through downtown Denver, half-finished buildings. You were energy city, and that's all you were. But now your finance, your tech, your aerospace has become a big player in your game, in your state, in your city, in the metro area. You're a much more diversified area. Just like, for example, Houston is too. The Houston also used to be a one-trick pony. Houston's not a one-trick pony anymore either. You've evolved. You've become a real community. You become a diversified economy with all kinds of jobs in different high-tech, low-tech, high-income, low-income, this and that. People want to move to Denver because there's all kinds of jobs out there. It's not just roughnecks looking for a quick buck. And that's the single most important thing. Secondly, as we've aged as a society, the boomers are getting older and so on, average age is drifting up. The desire to move to a place that's beautiful and that's attractive and that offers all kinds of amenities is much more important than it was 30 or 40 years ago when we were, as a country, 10 years younger, 8 years younger, and we had to make money and pay for kids and buy diapers. Now it's, The kids are now 13 or 14 on average. I'm making up the number. They're not out of the house on average just yet. But oh, move to Colorado so I can ski and I can do this and I can hike and I can fish and all these sorts of things. So we know Americans are moving to more attractive places. That's why there's problems with hurricanes and tornadoes and fires. Separate conversation. Places like Colorado are very desirable. In a recent report I saw, when they asked Americans what the top state they found most cool and nifty and appealing was Hawaii, and number 2 was Colorado. I live in Florida, it was number 6. I'm pretty happy. But you're number 2 because of all the amenities. And as we age and have more money and boomers live longer, the desire to live in a beautiful community will only grow.
That's an interesting distinction. So what I'm hearing from that, I think people that are choosing to move into Colorado, they're really making lifestyle choices as much as a job choice, perhaps, as well.
Absolutely. And the people who can move to Colorado for these jobs and lifestyle can do it because they're higher income and a little older, and they don't have to work from home so much. So you're attracting everywhere. Happens everywhere. You look at Aspen Vale, prices there have gone crazy too for the same reason. Oh, beautiful state, skiing, da 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 da. Denver also. Fort Collins, Springs, Castle Rock, whatever it is.
Yeah.
You had made a pretty fascinating.
You're a really cool, you're a great state.
You had made a pretty fascinating point back in August about the nature of the in-migration and out-migration that we're experiencing in Colorado. Can you explain that just a little bit? And then what does that mean for the housing market specifically?
Right. So Colorado's becoming an expensive state. This is both a good thing and a bad thing. Right? If you're a homeowner, it's great. If you're moving in from California, it's terrific. If you're moving in from Ohio, not so cool. But we're underbuilt in Colorado like we're underbuilt in many states. This is a chronic problem, not so unusual. But Colorado's particularly beautiful. People want to move there. So who moves there? People who have higher incomes generally, or from the West where prices are even higher than they are in Colorado, Oregon, Washington, California, right? So you've got people with money moving into your state, and they, as a result, jack up home prices because the price of a house in Los Angeles or San Diego or San Francisco or San Jose is substantially higher than it is in Denver. They're selling a house, they're making money. They can buy a house here in Denver they can gladly pay the list price or higher or get into a bidding war and get a house. So your population is changing. Wealthier people are coming in, generally speaking, and less people with less income and who are more challenged financially for any number of reasons tend to say, oh, I'll move out and I'll move to Kansas City where it's more affordable, or Minneapolis or Indianapolis or Dayton, Ohio, or Rochester, New York, where I can afford to buy a house that's more affordable and I'll have a chance. I know people who've done both. I know right now, as we speak, I know a couple moving from California into Colorado and a couple that wanted to move into Colorado who can't afford it. They're moving somewhere else. Lowering,
we, by the way,
good
have
income, but younger.
We, by the way, have 97 real estate agents on this call, and they're all wondering if you're going to refer those 2 clients to them. So bear that in mind. Are you seeing the Colorado population being pretty stable right now?
It's growing at a normal pace. For a number of years in the end of the last century and early this century, so 95, 98, 2000, 2005, 2006, you were a very fast growing state because your housing prices were quite affordable. You were effectively an inexpensive place to move. But over the last 20 years, you've become much more expensive because it's hard to build. And the in-migration was strong during those years. You're underbuilt, prices go up. Then the Californians move in, they drive them up more. And suddenly it slows down. But now you're going through, as we discussed, this changing people, rich people moving in, lower income people moving out. So that's driving home prices up. And the type of buyers are changing as well at the margin.
Yeah. There's kind of some maybe interesting examples that we have from across the country of a couple of major cities that have sustained higher prices and continue to go higher, like a San Francisco or an LA or New York, and there's a number of examples. And then we have a couple that are maybe a little newer. Maybe there was some fragility in their economy or some nature of their market that had them a little less stable than some of the older stalwart sort of cities. most recently, you had mentioned that Austin actually experienced a 10 to 15% decline in values, home values, just over the last 18 months or so. And Boise was another city that seemed to be subject to a similar decline. Can you tell us just a little bit about what is the nature of those cities relative to Denver, and then relative to some of those older cities that we might look at who have sustained increased values for a really long time?
Austin story is the poster child for COVID, I would say. It was people who come from there or whatever have to have a job somewhere else. Then COVID comes, they can come home. There's a big university there and so on, and they boom. They just go bonkers. I've spoken there a couple of times. I was saying a couple of years ago, this is great, but this is not may not end quite so beautifully. So prices now are coming down. Cities that did really well during COVID, where they had a draw of people or a draw of wealthy people in particular, right, or whatever combination, saw their prices go really up, are now seeing some of those prices come down. And where I live in Miami is one of those situations. We benefited mightily from folks coming from New York, moving down to Florida. Now it's over and prices are negative. Of the 15 fastest declining price cities, 15 are in Florida. Not a lot. They're declining 3, 4, 5%, whatever. Nothing all that big. So there's payback. And on the reverse side, you're seeing cities like Boston and Providence and Hartford were badly hurt, New York City, that were hurt by COVID. People left those cities because of high densities and so on, are now moving back because work from home is over. Those cities there are relatively cheap compared to what they were 5 or 6, 7 years ago, and they're doing better. And Denver's kind of in the middle. You're in the upper end of it all. You did very well during COVID, but not so well that you're seeing big price declines.
Yeah.
Yeah.
So a pretty happy story all in all. I mean, not that Austin's not a good story. It is a good story. They're suffering a little bit, 10, 12% decline at the peak.
Yeah.
Is there, I heard just yesterday that there's an economic forecast that expects about 600,000 people a year to be moving to Texas. And I'm curious if there are maybe a couple of fundamentals that we could point to that are similar between maybe Austin and Boise or other cities that you might point to, which I would point to two things in particular that I know about the Austin area. One is that in Texas, you can grow in every direction, where in the Denver marketplace, and I would say up and down the Front Range, you can kind of only grow one direction, which is east. And then the second is that taxes on housing is relatively cheap relative to Texas. Are those two pretty significant factors that may have contributed to the decline of Austin values relative to Denver stability?
Sure, I think so. Yes, they're both appealing places. They've all got some unique, occasionally some other weird stuff going on. But yeah, Denver's super appealing. It really is. The thing that you've got to do in Denver, I think, to keep yourself going and doing well is allowing more construction, create incentives to build. You build a house 50 years ago, the house now is old enough. Let's get rid of that house and get that parcel and build higher density and up so that you can get more people in without having to keep moving closer and closer and closer to Nebraska, if you will, right?
Right, right.
I hate to hear this. We're running out of space. We're running out of land. That's a land use proposition, and build up. People will buy. Builders will build. Realtors will sell. This is the sign of a healthy function.
Yeah.
Mark is cheap, and yet we can change this. This should be
You know,
encouraged.
one of the things, Elliot, I'd be interested to hear your perspective on. One of the things that Matt and I have talked about, and we're seeing the ship begin to turn just a little bit. So over the past year and a half, 2 years, you know, sellers have been hesitant to sell because they're locked into a 2.5%, 3% interest rate, and they want to sell, they want to move, but they've been hanging on, obviously impacting the shortage of housing possibility here in Denver as well. We are beginning to see that turn a little bit. I think sellers are realizing that, hey, it is what it is. This is where we're at interest rate wise, and they're ready to make that jump. So we're seeing an uptick in the number of houses available. Is that similar to what you're seeing across the nation as well?
Yes, it is, and you hit it on the head. It's under normal conditions nationally, we sell about 5.5 million homes a year, ballpark between 5 and 6. That's sort of normal. Rates are
Yeah.
lower, a little more, whatever. But now we're selling barely 4 million homes a year. So we're underselling by 1.5 million homes. And they're not selling because people have these low mortgages. And but a primary way they're going to move from that low mortgage of 4.25, 3.75, whatever it is, to a new house is if the new mortgages fall below 6%. They have a 5 handle on it.
Mhm.
People can't wait forever. Life goes on. Putting bunk beds in the bathtub for the octuplets isn't a long run solution here. So you wait a year, you wait 6 months, you wait a year, you wait a year and a half, you wait 2 years. Imagine a dam and the water level's rising because every year you're adding 1.5 million gallons, 1.5 million unsold homes that people want to sell. Eventually, the water's going to get over the dam and the water's going to start to lap and go over the dam. And that's what we're going to see in 25. So I expect 25, even if rates don't change, to see more sales in 25 than 24 because you've got now 3 million people nationally, 30,000 of them, which are in Denver, for example. I'm making up a number that's probably close. They've got to go. Some of these people just got to go. And they're gonna result in a home sale. So it's don't give up. It's keep pressing, keep telling people you're around, and remind people, don't give up. And look, you got to move. You got to move. People got to move.
You were suggesting about a 5 to 10% increase in volume in the market, even with no interest rate changes. You still feel like
Correct.
that's about the number? Yeah.
Right.
Yeah, I was saying 10 to
It has to
15%.
happen.
Maybe that's my optimism.
15?
I've been saying 10 to 15, maybe as much as 20%. That was my optimism. But I also, from everything that I was reading, I think a lot of people were toward the latter half of 2024. We're expecting interest rates were going to continue their decline. When we saw rates get down to, the mid upper 5% range, there was a lot of enthusiasm and a lot of velocity increase in the marketplace.
Yes, if you look at the data for refi activity and financing activity around week 37 of 2024, you see a big jump up. It's really important for the realtors, your guys, right, to be very tuned to these rate declines because you never know how long this window will last. But if you see the window opening, you got to run through that window quick and get all your buyers and sellers and get them all moving and have a plan in place and whatever it is you can do to grease the skids. It's critical because people are very responsive.
So that's interesting. I've got a couple of questions. We had a couple of questions come in, but I want to just dig into that one just a little bit. If the agents on the call can really hear this, and any buyers and sellers that are on the call, what are the 2 or 3 things that you're looking at that are the lead indicators of, oh my gosh, the opportunity is coming in the market. We ought to be ready and take action if X occurs. Can you point to a couple of those things for us?
The most important variable to focus in on is months of inventory. For some reason, we all tend to focus on volume, units. At the end of the month, NAR tells us there's 800,000 or 1.3 million or whatever it is. And then they say, and that represents, 3.4 months or whatever it is. It's the 3.4 months. It's the months of inventory because that's the intersection of supply and demand. And that's the magical number. As that number goes up, and it's been going up slowly because we were in a very strong seller's market with very low inventory, months of inventory, we're slowly going up. And as it goes up, home price appreciation will slow down. And that's important to understand the market dynamics. But the intersection of supply and demand, that months of inventory will tell you a lot about price appreciation. And if it gets really big, I'm making it up, 8 or 9 months, it won't get there. Don't worry. That would represent price declines. Actual price would go backwards. So if you look at one variable, one metric, that's the one.
Okay, fantastic. We had one question. I just want to kick this off real quickly. We'll get to a lightning round here in a few, I think. But one of the question was, do you believe that the wildfires in California and the devastating impact that they've had will create a larger influx of people to Colorado? And one perspective that maybe I'd love to share is that I have some family members in California. They've really struggled with the cost of insurance. The cost of insurance is going to become catastrophic, I think, for homeowners, particularly multifamily in California. They've actually passed, or I think we're trying to pass a law as early as 2 days ago to make sure that insurance companies couldn't pull out. If there is an influx of people coming to Colorado or other states, do you believe that it's because unmanageable costs like insurance are going to drive people away from home ownership?
It's one of the several things that are going to happen. We're going to see inevitably in California, in the LA area, metro, the LA basin, we're likely to see rents go up. They're going to try and quash the gouging activity, but it's going to be somewhat difficult to do that. You're going to see lumber prices go up for new home construction. There's a lot of new home construction that's going to start taking place in Altadena and Palisades and so on. That's going to jack up a little bit. Some people are going to move away. You already have a taste of this from the fires a couple years ago in Louisville and so on. I forgot the name of
Marshall
that
Fire.
fire area, but you know what I'm talking about. And that
Yeah,
did
the
all
Marshall
kinds of
Fire.
things to your housing markets too.
Yeah.
Yeah.
And that was a very
Yeah.
small fire. But yes, the insurance issues are gigantic. And Colorado, unfortunately, is not immune to that problem either. So
Right.
California's the worst. But the key thing here, and this is important for realtors and builders and everybody, we can build homes better. I mean, we can have tin roofs. We can try and get ordinances changed. We can change or get rid of shrubbery. We can have more rocks around the place, less things to burn, and so on. When a realtor shows a house, they should be able to say, look, we can fireproof this house to a large extent. And we can get your premium as a result drop by making this all up, right? 20% or something. This is important to point out going forward because these insurance rates are going to be higher. Generally, there's more, not more. The storms and hurricanes and tornadoes and weather patterns are worse because of global warming. And they're worse because more people are living in areas that are being adversely affected by these bad storms and hurricanes and tornadoes and whatever it is. So these insurance companies have real issues involved here. And it's our job as homeowners and builders and realtors to mitigate as best we can. And there's things we can do. We have power of agency here. We really should be helping get these homes better designed, structured, and retrofitted over time to withstand more, worse temperature, whatever.
Yeah. The did you have a question?
I was just going to say, I'm sitting here, Elliot, thinking too, and Matt, you and I've talked a lot about this. We're going to be facing one of the largest wealth transfers that we've ever seen with the baby boomer generation. What's your perspective on that? One nationwide and specifically in Colorado about that wealth transfer and specifically how that impacts real estate here in the Denver area.
It will be a boom. There's no question. The issue here is we've thought that some of these wealth transfers in past generations would generate lots of increased wealth in the younger generation.
Right.
It doesn't come quite as cleanly as we'd like. People living longer, healthcare is more expensive, and so on. So don't bank on this and don't bank on it today. The chances of it happening are absolutely strong and powerful. And people will, when they have this windfall of money, and it's not that many people, right? It's more a few people with a lot of money than a lot of people with a little bit of money. That said, those people who get those windfalls from inheritances are going to say, let's enjoy life and let's do something nice with this money. In many cases, they want to leave a legacy and say, this money comes from my parents, and I want to do something nice to remember my parents by, and I want to buy a house in a community and love resident so my children can come and they can enjoy the money that my parents provided and so on and so forth. So this issue of legacy, we talk about it, and at some level, it's not so true. But at levels, it really does have a manifestation. And how can you appeal to these potential new buyers with this wealth and make them feel at ease, give them purpose, and have them purchase something that gives them satisfaction on an annual going forward basis? I'll give you a very silly story. My father died not long ago. I'm going to tear up a little bit here, but it was like $20,000. It wasn't a lot of money. And I thought, how will I remember my father on a daily basis out of this relatively small amount of money? I mean, it's big in the grand scheme. And I bought furniture for my house. Bought a living room set, beautiful living room stair. I bought a kitchen, an office chair for myself. And every time I sit down, I think of my dad. And for people who have more money, they can think every time I drive up to this house, I can think of my mom, I can think of my dad, I can think of my grandparents. And it gives them purpose and life and value, and it transcends the home.
Yeah. Yeah. It could be the vacation home. It could be the mountain property that they're able to purchase and carry that legacy on for their own family as well. So
Right. And even if it doesn't go beyond them to their kids, it's for them every day and it's meaningful.
Yeah.
There's purpose.
Yeah. Love that. Love that.
Let's talk about the pending housing crash in the Denver marketplace or the Colorado marketplace that probably most likely is not going to happen, and why. And I think that this is just an important, we experienced doing, live interviews going all the way back to 2018. And we had naysayers pointing fingers at us and saying, you guys are just real estate agents and you're trying to convince us to buy houses because you guys benefit from the commission associated with it. Our passion, our motivation is to help people live the way they want to live and to help people build wealth if real estate is a mechanism by which they want to build wealth. But I do think that it's important that if we can distinguish the handful of fundamental principles to the marketplace that suggest we are not going to experience what we experienced in 2008 through 2011, and why not? Can you just give us that quick overview?
No way. The reason people keep referring back, or a few people refer back to 08, 09, has been the rapid increase in home prices. But the rapid increase in home prices that occurred in 08, 09, 06, 04, 05, 6, 7, the lead up to the housing bust, was primarily because of a credit bubble. And credit got very easy to attain. If you look at the Mortgage Bankers Association, they have an index of credit availability. It was like literally 900, and now it's like 90, literally. So it's fallen by 90% or 900%, depending on direction you're looking at. It's a tenth of what it was. Back then, it was easy to get money. People could borrow money easily. They could build a house or buy a house. Builders were building houses. Securitizers were securitizing. Appraisers were appraising, and so on. And we knew this wasn't good. We knew it was going to end badly. We didn't know how, and we were overbuilt. We were overbuilt by the end in 08, roughly, by 1.5 million, 2 million units. Now it's completely different. We're underbuilt by 3 million, 4 million, or 5 million, depending on how you measure. Call it 4. So we were overbuilt by 1 million. Now we're underbuilt by 4. Well, you're underbuilt, and there's strong population gain, household formation at the ages of 33 to, going from 38, 39 down to about 20. There's a huge population of people eager to buy a house. Annually, we're not building enough houses to shrink that shortage of 4 million. So yeah, prices can obviously go up and down a little bit. They can fall a few percent here or there, whatever. There's no systematic possibility of price decline because we're vastly underbuilt. And that's what makes this difference. And the people who are getting mortgages, they have high FICO scores too.
Yeah.
And unemployment in 08, 09 peaked out at 10.5 or 11%. Right now it's 4.1, and maybe it hits 5 if things go terribly, 5.25, what it was. So we're underbuilt. Unemployment won't get so bad. FICO scores are very strong. There's no prospect of enough homes being built to dramatically shrink that 3 or 4 million, 5 million unit shortage. You fundamentally cannot compare 06, 07, 08, the run up to the housing bust, 3, 4, 5, 6, to now where we are now, 24, 25, 26. Don't even go there. The total number of homes that are upside down in the US today is under 1 million homes. And those are homes that were purchased in late 22 in Miami and in Austin and so on. These are unusual. They're small. Moreover, even if home prices decline by 5%, suppose in Denver they fall by 5, it's almost big deal because the home appreciation was so strong in the last 5 years. The home price went from, I'm making up a number, Denver median, 350 to 550, something like that. So if you sell that house for 5.25, so what? You've still made a tremendous capital gain on that house. So you can afford to lose a little bit at the high end and you're fine. Whereas 13, 14 years ago, every price decline meant you had to come to the table with more money and you were overbuilt and more houses were coming online and prices were dominoing down. No, don't worry.
So one follow-up thought and then one question for you. Let me ask the question first. So by way of extension, would you say that Colorado, and maybe you know an exact number, that Colorado is underbuilt, has fewer homes by maybe as much as 100,000 or so, maybe even
That's,
more than that relative to the 4 million underbuilt across the
that's
country?
a reasonable number. I don't know. I haven't looked into it, but I would bet dollars to donuts. That's a pretty good number. Maybe
Okay.
higher, may well be higher,
Yeah.
but it's certainly not lower
Uh,
than
well, I guess one other ingredient in any perspective that you have to share on this, one other ingredient with regard to housing stability is that in addition to the purchasing mechanism, meaning the 30-year fix and the low interest rates and the high FICO scores, that and all of the equity that people have in their home, what really caused the burst in 2008 through 11 was all the foreclosures and all the short sales because people were upside down in their home. A lot of that was because of adjustable rate mortgages and other types of mortgages that were terrible products. We're going to
that.
see some of
No
those come
dogs,
back, by the
option
way.
only
Yeah.
liar loans, right?
Exactly.
Yeah.
Exactly.
Yeah.
Yeah. I mean, literally no income, no asset,
No,
no job. Didn't even have
no
to state a
problem.
job for
No
a period
problem.
of time. And so it seems then the conclusion is that even if people lose their jobs, even if unemployment increases, that they've got a tremendous amount of equity in their home. They have a mortgage rate that's incredibly low on a mortgage that is relatively low, which means they're going to fight tooth and nail to keep that property because even if they sell it, they can't find a property, even a rental property with a mortgage, with a payment that is less than their current mortgage payment. Is that pretty true across the country as well?
If they lose the house, this is important also. In the past, in 08, 09, when they lost the house, these people were angry. They were upside down. They're going to declare bankruptcy. Their credit's wrecked for 6 or 7 years. And they ripped out the copper piping and sold it and sold the appliances. In some states where you aren't supposed to do that, it depends on different
Yeah.
states. Now, under the worst conditions, when they haven't paid the mortgage in 8 or 9 months and the house is sold out from underneath them, the owner now of the house, the lender that's not getting paid, will say, keep the house nice, mow the lawn. Because when we sell the house, they're going to get a check for $175,000. They'll be unhappy to get the check, as you say, because they'll have no other recourse. They'll have to move away. But they're not going to be upside down and having their credit trashed as a result. So the behavioral manifestations of the homeowners is different. And you're right. Back in 08, 09, they strategically defaulted on their home and kept paying their credit card and their car payment current.
Hmm.
And now they're saying, well, I better pay my house mortgage, but I'll let my credit card go. Or my
So that was
car
going to be the
payment,
next
God
question.
forbid, go. I'll keep one car, not two. And that's how they'll save 600, $700 a month, but they're going to keep making the payment on the house.
Yeah,
Yeah.
that was going to be the next question. We've talked a lot about household debt, and I'm curious. I mean, we have the highest credit card debt per household, I think, in the history of the country. I don't know
Yeah,
what auto payment defaults have looked like most recently. They were definitely growing over the
they're
last,
up.
what, 18 months or so. Can you give us a little bit of perspective on how household debt might be impacting both economy and housing market, and kind of what's the consumer behavior around that?
Not too worried about this. What we're seeing, yeah, auto loans default rates are up, credit card defaults, even home mortgage defaults are up a little, delinquencies are up. And they're up because you're comparing in many cases back to 2020 when they went very, very low because we didn't have to pay our rent, pay our mortgage, pay our student loans, and so on. So they were artificially depressed. But even now with the home mortgage delinquencies, 30-day delinquencies are up, they're still lower than they were in the housing boom of 06, 07, when things were very, very good. And they're now roughly back where they were before COVID in 2018, 2019. So I'm not sitting here going, it's up, yeah, but it's up only because it was artificially low. That's a very different story. Credit cards are up. We talked about that. Auto loans are up and they're coming down. And what's going on there generally, is lower income households are beginning to show signs of stress because
Mhm.
they don't own a home and they don't own a stock portfolio. If you own one of those, a house or a portfolio, you're doing pretty well. If you own both a home and a stock portfolio, you're rocking. You own neither, you're really struggling. And that's what we're seeing. We're seeing really financial stress is beginning to manifest themselves in the lower income strata, both. And that's a little worrying. It's not going to cause a recession and that sort of thing, but it's like it's not a great thing. You don't want to see households really struggling here. But it's confined to this particular area. That's the important thing. Now, In terms of household wealth, yes, debt's up, but debt as a percent of GDP, not a problem. It's declining. Credit cards as a percent of GDP are declining. Debt compared to where it was in 08, 09 is way lower, way lower. That's a high level, but it's fine. Thank you very much. And net worth has gone way up. And net worth includes debt. It has all your assets minus all your liabilities, which is home mortgages and car notes and so on and so forth. And that number has gone up almost 50% in the last 5 years. From 2000, just before COVID, in February of 2000, so literally 5 years ago now, it was $120 trillion, so 4 times GDP. Now it's almost 180 trillion, close to 6 times GDP. It's gone way up. So yeah, debt's higher, but wealth is much higher, much more. And therefore, again, have a home, have a stock portfolio, you're good to go. And these are generally going to be people who are buyers.
So if I may summarize, tell me if this is an accurate statement. You're seeing that it is kind of lower income, non-household or non-home owners that have pretty significant household debt, credit cards, car payments, and are defaulting on those. And that in theory, because of that, may not have much of a cascading impact on people putting their homes on the market to sell, to take the equity out, to have to pay off those debts.
I think that's right. And in many cases, people who are young, they're 25, 26, they don't have a house because they're too young. And they don't have much of a portfolio because they're pretty young too. Those households may be well in pretty good condition, pretty good shape. So let's not just look at the homeowner versus not. There's also an age issue and all that sort of stuff involved here too. But yes, I agree with you generally. Yes, absolutely.
Okay. We have an inside baseball, pretty sophisticated question that we're going to ask you and see if you can dumb this down for us. Here's the question. And then I'll share with you what the follow-up question is at the same time so you can answer both. I believe we're seeing bond investors push back against our high government deficits. What role, if any, do you see bond vigilantes impacting bond yields and in respect to the 10-year Treasury? And the follow-up question is, what impact does the new administration's policy potentially have on the dollar and our economy with a ripple effect to real estate?
All right, so let's do them both. I will have forgotten the second. I've already forgotten the first one. Oh, the bond vigilantes and the debt deficit. Okay.
Deficit pushback on 10-year bond. Yeah.
So I think, look, we're all concerned. If Trump is able to extend the tax cuts that he enacted in 2017 that went into effect in Jan 2018 that expired December 31st, 25, if he extends those for another 8 or 9 years or whatever it is, that would increase the budget deficit over the next decade by $4 trillion, a lot of money. The margin that should definitely raise long-term rates a little bit because the government's going to be hustling for long-term money and the private sector does, and the government money will push out the private money and the crowding out effect will drive up interest rates, all else equal. So yes, I am concerned, and I'd like to see us get our fiscal situation house in order, bring our budget deficit down so the debt to GDP ratio comes down. So these long-term rates have a chance to come down for fundamental structural reasons, financial reasons, budgetary reasons. Yes, absolutely. So I'm a little worried. I mean, it's a very slow moving process, but it's a moving process. And we're not doing anything to improve it. Our deficit now, our debt to GDP, about 100% of debt to GDP, is manageable, but it's getting high. And there'll be a recession down the road. It'll get worse. I don't want that. We need to really, when times are good like now, is the time to reduce this problem by cutting spending, raising taxes, whatever it is. But Washington seems constitutionally incapable of doing that. So I'm a little nervous. The second question dealt with the dollar. And the dollar has been on a terrific ride for the last year or two. I mean, if you want to travel, go to Japan, go to China, go to England, go to Europe. Everything, Australia, everything is on sale now. So it's a great time to travel. And some of Trump's policies are likely to strengthen the dollar. The tariffs in particular are likely to strengthen the dollar. There'll be less demand for our stuff, and that will drive the dollar up even higher. So buying a second home, a lot of Americans can now afford to buy second homes in Canada, for example, more easily. I'm actually thinking of that. I come from Montreal. I'm talking to my sister, hey, let's buy a house in Montreal. Prices are 40%, 42% off, 43% off right now. So as realtors, you may really want to be able to find referral business in Mexico, Canada, Dominican Republic, wherever it is, or Puerto Rico, I don't know. This should be a slice of your income should be referrals of clients you have. They're looking for second homes in foreign countries, Italy, Spain.
I would imagine then the reverse is also having an impact on foreign capital investing in U.S. real estate, where we have less foreign investors in the United States. Is that true?
Right. And absolutely the cost of America in pesos or whatever, Brazilian, Mexican, whatever currencies, Canada certainly they're having a hard time. They may want to sell. They may say, "Oh wow, this is a great time to sell because in my home currency in Canada, this house is worth a fortune." So you're going to have reverse, and there's opportunity there as well. Hey, I'm a realtor expert in selling homes of non-US citizens, for example, and there's tax laws and retained money for the government and whatever. I know all that stuff. I can deal with that. I'm your person. Take
Yeah.
advantage of that opportunity too. Yes. And there's always people taking money from foreign countries that are under duress. Syria, I'm making up an extreme example, but people want to get their money out of somewhere and put it into US real estate because it's safe.
Mhm.
Sure. We have about 5 minutes left. Mike, why don't we do a couple of questions?
Questions? Awesome. So first question, how about population decline and long-term implications?
Well,
Did I
next
get all of that?
question.
Yeah.
I'm kidding. Okay, so um, the data here is very clear. US population will decline by roughly 20% over the next 60 or 70 years if we don't have any immigration, because the number of births, live births, has fallen. We need 2.1 children per woman lifetime to keep population flat. It's now 1.7, a decline of 20% from that 2.1 number, which means over the next 60 or 70 years, there'll be a straight decline in our population from roughly 330, 340 million now to 270 million. That decline will not occur in Denver. Denver's a thriving, dynamic, growing, urban, cool, young, nifty, great mojo place. But other places that are less cool and less exciting, maybe Syracuse, New York, I'm making up a place. Not that it's not a great place. Those places will shrink, home places will decline. It's not a happy story. So all else equal, this is what our future holds. China is going to shrink from 1.4 billion to 800 million over the next 70 years. And they have no prospects for immigration in China. There's always a little immigration, but no meaningful amounts of immigration will occur. And this cake has already been baked based on one-child policy and so on and so forth. That's been going on for 50 years. They've reversed it. It's too late. Doesn't matter. Done. Our case is different. Immigration desires to immigrate to the U.S. are strong. We should harness that in a legal, appropriate, congressional way.
So the net effect of that, if I'm understanding you correctly, and this is also my opinion, so don't let me project. Tell me where I'm incorrect about this.
Okay.
That we must have immigration in order to have a thriving economy. Whether that's illegal or legal immigration is a separate conversation, but that we must have immigration because the average household is not growing at the pace that we used to. We're actually on a population decline based on natural births.
Correct. And the question Congress in front of Congress, and you and me could solve this problem in 5 minutes. The solution here is clear. And I'm stepping on someone's toes, I'm sure, in the audience, and I don't mean to do this, but it's build the wall like the Republicans want and open the front door, which the Democrats want. You're going to get the best of both worlds. You're going to keep out the bad guys. No one really wants illegal immigration. There's not a big thriving demand for illegal immigration. We want legal immigration, bringing people who have skills that we need and can do computer programming or building houses or whatever it is. And this would be a boon for our country. There'd be general consensus that's what's appropriate. There wouldn't be this hostility towards these immigrants because they're coming in illegally. I've gone off the ranch here. I apologize.
No, not at all.
No, that's good.
And I think this last question that we had, and then I have one other question, and then we can
Sure,
wrap up.
I have time. We can go beyond. Don't worry about it.
Just confirming, you said there were about 1 million homes that are upside down right now in the United States. Is that correct?
Last I checked, it was 925,000 or something. But yeah.
Okay. And that's a little less than 1% of all residential properties across the country.
Oh, way less. Yeah. It's very low. It's about 2% of homes with a mortgage.
2% of homes with a mortgage.
With a mortgage,
that's
because
great.
50 million homes have a mortgage, because 30 or 40 million are mortgage free.
Yep, perfect. Um, my last question for you. So we started with macroeconomic, and briefly, you can bring this picture back. That'd be great. We started with macroeconomic. We really drilled down into what's happening in Colorado in particular. I'm curious. Certainly, there's lots happening in the world, and again, there's new administration coming in. Maybe there's going to be some stabilization, maybe some destabilization, because apparently we're going to buy Mexico and Canada and Greenland and Panama Canal, and who knows what the hell we're going to do now. But all of that said, is there any particular geopolitical issues that you see occurring that are impacting the economy that ultimately impact housing?
Okay, so the one that makes me stay up at night, if you force me, is the Middle East. And if the US, Israel decide to go after Iran's nuclear facilities, nuclear bomb they're building, which wouldn't surprise me, how will Iran respond? And Iran might well respond by closing down the straits, right? And not letting oil ships get out straight to Hormuz. That could jack the price of oil up considerably to 130, 120 bucks a barrel without much effort. And that would have some reasonably serious deleterious effects in our economy. That's the one. The other one is Taiwan. The Russian invasion of Ukraine, yeah, whatever. It's small fry. It's terrible, but it's not geopolitically important. The Israel thing with Hamas and Hezbollah and the Houthis and whatever, yeah. It's bigger, but not big enough to wreck the economy. But China invading Taiwan, that's a whole new story. So I would say it's Iran, US, Israel, Iran, and then China, Taiwan. Those are the two really big elephants in the room.
How long will it take, do you think, with deregulation and the kind of drill baby drill and fracking mentality for the US to become energy independent again with the new administration?
Oh, we are already energy independent. We are a net exporter of energy. We unfortunately, it's a really weird story. The Bakken shale in North and South Dakota and the Permian Basin is really great oil. Our refineries are designed to take lower quality Venezuelan oil that's heavy and sour, as opposed to U.S. oil, which is light and sweet. This is the sulfur and all this other stuff, and the measurements of how much power is in the oil. Someone else knows more, I'm sure, on the call than I do. So we export lots of oil and we import lots of oil because our refineries need it that way. But we're the world's biggest producer of oil and natural gas. We are in total a net exporter of hydrocarbons.
So the cost of oil increase is simply the capitalization of those oil companies being able to export more at a higher price across the country, which then has an impact on the cost of energy domestically.
Sure, if we forced the companies not to export and prohibited them from exporting, natural gas and oil would be cheaper in the US and we would consume too much. It would be inefficient. It would be a bad outcome. It's better to sell it to the high bidders outside, have us pay a higher price. As an economist, I'm good with that one. We don't want to artificially subsidize because that will make us all buy bigger cars, bigger houses, bigger boats, be more profligate with our energy consumption, and waste a good resource that somebody else would pay more money for. Other countries have gotten into these bad situations of subsidizing this, and it's an expensive proposition. It's let the markets function, let them export where they can.
Yep. Okay, fantastic. Can you, yeah, go ahead.
I was just going to say, we're at time. Did you have another question?
I was hoping you could give us, kind of your 30-second summary of, tell us where, one more time, how positive we should be about Colorado economy and the housing market across the Front Range.
At a macro level, I have not been happier than I am right now in at least a year. For a year or so, I was thinking we might get a recession. No, data was revised. Consumer spending is good. Unemployment is low. We're good. It's generally a really good story. I've rarely been happier. Am I a little nervous of what can happen in Washington? Yeah. That said, life, limb, and liberty are never secure when Congress is in session. Mark Twain said that like 150 years ago. So nothing has really changed. Front Range, you're the second most desirable state to live in the country. Your weather is great. Your income taxes are property taxes are very low. Income taxes are quite low. People are moving here. Demographics are favorable. Just build more homes and keep the prices from going up too much. But you're not just good looking and smart, you guys. You're lucky too to be in Colorado.
So what I just heard is we are smart,
Good
lucky,
looking.
and good looking.
Yep.
Okay. That's gonna be our
takeaway.
theme for the entire year. Exactly.
That's the entire takeaway
right.
of today. Elliot, thank you. As always, a wealth of knowledge. Thank you for taking the time to be with us as well. Thanks for talking to our audience today also. So really, really appreciate you.
Thanks for being with us, everybody.
It's a pleasure. I look forward to next time. Thank you, guys.
Yep. Happy 2025.
You too.
Awesome.
You as well.
Bye-bye.
Thank you.